all so early in the morning to see so many wide awake faces. And as always, I'd like to thank the Friends of Concordia and BNY Mellon Wealth Management for their support, especially Jane Staunton, who is here. Their support makes this business breakfast possible, so I am most grateful. Thank you. And now for our special guest. I'm delighted to welcome a friend and Bronxville neighbor, David Henle. I'm going to put on my glasses so I get it right. Former partner and global head of private wealth management for Goldman Sachs, David also managed DLH Capital Management, a $100 million hedge fund specializing in financial services with a focus on emerging markets. Julian Robertson recognized David as one of the most successful hedge fund managers, and to quote Mr. Robertson, "To be a good hedge fund manager," he said, "you have to be absolutely honest, intelligent, competitive, and be able to get along with the team. Beyond that," Robertson added, "I think there's something strange in that the makeup of the most successful hedge fund people, they have a real interest in making this world a little bit better than it was when they got into it." David Henle has certainly made a difference at Goldman Sachs, at DLH Capital Management, at his alma mater, Union College, where he's a member of the Board of Trustees, the Executive Committee, and Chairman of their Investment Committee. At the Adirondack Nature Conservancy and Adirondack Land Trust, where he is a member of their board, and to the U.S. Ski and Snowboard Team Foundation, where he is a trustee. And this morning, here at Concordia, he is making a difference for us. Please welcome David Henle.
Is this on? Okay.
Up is
okay.
back, down is the other.
Great. Thanks, Ellen. And it's great to be here with everybody. I'm going to go right into the presentation, if that's okay. And first of all, I want to thank J.P. Morgan, Goldman Sachs, and Gerber Taylor, which is a consulting firm out of Memphis, Tennessee, whose slides I've generously or liberally stolen for use in this presentation along the way. So I just start by saying that, you know, the investment climate, at least in my 40 years experience, is one that I am, you know, largely unfamiliar with. I think this is one of the most extraordinary times that all of us have ever lived through, certainly extraordinary from my perspective. And that is because of the extraordinary efforts that are now being made by the government to effectively keep the economy running. We basically started down this road of getting into a problem with what was a massive credit cycle. I mean, what happened was there was a very liberal, kind of generous-minded banking environment that took place for the last 10 or 15 years. The Fed also was incredibly lax in its lending standards in hindsight, and I think Alan Greenspan and others have to take some amount of the blame for that. And so what happened was you had this credit cycle effectively turn into an asset bubble, because when people can borrow money cheaply and when the economy is not growing as quickly as lending is growing, what happens is those excess dollars wind up in the form of assets. And you know, most particularly, it wound up in the form of houses and housing prices, but it wound up in affecting a number of markets, whether it was the art market, whether it was gold, whether it was other collectibles. And so what happened is when that bubble popped, the Fed basically had to step in and transfer a lot of those distressed assets onto its own books. They effectively came off the books of a lot of the banks, not all from the banks, but a lot of it from the banks, and went onto its own books to basically keep the system from collapsing. In addition, government spending at that point was increased dramatically. We were running along until 2009 with deficits somewhere in the range of $150 billion to $200 to $300 to $400 billion a year. Those deficits today, as we all know, are running at a rate of about $1.1, $1.2 trillion a year, which is really extraordinary, and which is obviously not sustainable. In addition, and in part because of those deficits, the Fed is now keeping rates extraordinarily low at this point in time. Now, that's benefiting some number of people in this room, I'm sure, by virtue of the fact that you can now get a 30-year mortgage for something under 3%, but I'm certain, too, there are a lot of people in this room that are being harmed by that in the sense that you know, the rate of return that you can earn on what I'll call lower risk or non-risk assets is effectively zero, and the Fed is determined to keep it that way for some period of time. And we are going to be in this deleveraging mode for a while to come. This is not a small problem. This is a big problem, and it's going to take not months. It's going to take years to fix it. In addition, Europe is as big, we could argue, even a bigger mess than what the U.S. is at this point in time. So just a couple of examples of this. And what I've taken here is a look at total assets of commercial banks. Now, not all assets at commercial banks are loans. They own securities too, but you can see how levered up the banks got in the period from 2002 to basically 2010, growing their asset bases at really 5 times what the growth in GDP was. And more typically you would expect loan volume and asset growth to be something in line with GDP. It was anything but that during that period of time. And so that's where a lot of this easy money went. It went into people who could borrow easily, going out and buying second homes, buying artwork, buying whatever it was. And a lot of that wound up on the balance sheets of the banks. And then you can see since the beginning of 2010, we've gotten back to what is a more normal environment, which is obviously a good thing. This is the balance sheet of the Federal Reserve Bank of the United States. And the reason you want to pay attention to this is this goes to show you when all those bad assets started to come apart and would have effectively bankrupted the banks, the Fed basically came in and bought a lot of them. They upped their balance sheet by $1.3 trillion in literally a matter of months back during the crisis in 2008. And you can effectively see that since that time, the Fed's balance sheet hasn't gotten smaller, it's gotten larger still. And this is where a lot of people have concerns about things like long-term inflation, because effectively the way the Fed buys these assets on an ongoing basis is, at some level, it's effectively printing money. And so over a period of time, it's either going to get paid back on all these assets because they're going to be productive assets, and this balance sheet will shrink, and the money supply ultimately will come down, or that won't happen, and you're going to see, the effects of some long-term inflation. I don't sense that's an issue for us at the moment, and I don't sense, frankly, it's going to be an issue for us for the next 2 or 3 years, but you can understand why there are a lot of people that are very concerned long-term about the state of inflation and the state of the economy. And let me just say, the size of the Fed balance sheet at this point is $2.8 trillion. The entire size of the U.S. economy is about $16 trillion. So there are a lot of assets on its books, which over time, those have to come back off in one way or another. This is a reasonably depressing chart that shows you the state of where we are today. So the fiscal 2011 deficit was $1.29 trillion. The fiscal 2012 deficit was $1.09 trillion. 2012 GDP, this is on a September year basis. That's when the U.S. government closes its books. Just ended was $15.6 trillion. Total federal government debt at the moment is $16.2 trillion. Now, some amount of that is intra-governmental, so it's government agencies owing it to each other. So the important number to look at, or the most important number, according to most people, is the $11.4 trillion, which is the debt held by the public. And that is currently about 70% of that GDP number of $15.6 trillion. When you start to approach 100% debt to GDP or 120% debt to GDP, most economists believe that's a very unsustainable level, and a level at which you simply are unable to repay your debts because you can't grow quickly enough. Interest expense on the federal debt is $225 billion at the current time. The implied interest rate on our external debt is 1.97%. I mention this because you can scare yourself pretty quickly here if you believe we ever go back into an environment where you normalize interest rates. So, I don't know what the duration is of the average, amount of government debt. it's probably not as long as 10 years. It's probably a fair bit shorter than that. But if you took the 10-year U.S. government bond average for the last 60 years, which is about 5%, you'd easily more than double that interest number of $225 billion. And that to me is interesting because if you look at the two percentage numbers down near the bottom, even at a 1.97% interest rate, interest expense in 2012 was basically 6% of all of the money that the government spent. More alarming, though, it was 8.6% of all of the money that the federal government took in. So because we're running those $1.1 trillion deficits, 8.6% of every dollar that you pay in taxes today basically goes up in smoke and pays for past sins, and to me is representative of how we're effectively mortgaging the future of our children. And again, go double these interest numbers, if you will, and if you doubled them, net interest expense would rise immediately to 22% of all the money that the federal government takes in. Now that's basically money that can't be used to grow jobs, can't be used to grow economy, can't be used to grow productivity. That's simply, interest on the national debt. So whether you're Republican or Democrat, we have to find a way to fix this. We can fix it with higher taxes, we can fix it with lower spending, but it's got to be addressed, and it should be a concern to all of us. And it has obviously implications for how you think about the investment world. This is just an example of how the Fed is basically, maybe manipulating is too strong a word, but how the Fed is manipulating interest rates at this point in time. Interest rates are at their lowest historic point ever, from my math. Now, interest rates have been coming down for the last 30 years anyway, since about the 1980s, but you can see here that we are effectively now at the lowest 10-year rate that we have been at in at least 55 years. And you're also looking, if you will, at zero to negative returns on 10-year bonds. So one of my messages here today is going to be really careful what you do in terms of the duration or length of whatever bonds you buy, because at 1.7% long-term 10-year government interest rates with inflation at 1.7%, your real rate of return on fixed income at this point in time is zero. You're effectively just making back inflation. And as you'll see in a minute, historically you've earned about 200 basis points of real rate of return on bonds. That's not the case today. This just goes to show you, in a sense, what a mess the European governments are in at this point in time too. My apologies, there's one correction here. The European Central Bank balance sheet is not $3.1 trillion, it's 3.1 trillion euros. So it's about 4 trillion US dollars equivalent. So, it's 1.5 times the size of the Fed's balance sheet. And let me just say the European economy is similar in size to the US economy. So you can see Europe's got even bigger problems than we have. Spanish GDP is about $1.6 trillion. Its debts are about $1.1 trillion. So it's in the best shape of all of the what is derisively referred to as the pigs. Italian GDP is $2.2 trillion. Its debt is $2.5 trillion at this point in time. So well in excess of GDP. And Greece, at its worst, with a $300 billion economy, had about $500 billion in debt. Virtually impossible for them to repay that money. That has been marked down to about $400 billion, but you're still at a point in time where it's perceived by many that Greece simply can't grow its way out of its problems. And you're seeing lots of toing and froing going on right now about, Germany wanting Greece to be very disciplined and cut expenses. Others saying you can't cut your way to prosperity, you've got to spend even more to try and get the economy to grow. I don't know what the ultimate answer is, but I do know that this, as with the U.S., and maybe even more so than the U.S., this is going to take years and years to unwind and is going to create a drag on European economies because it has to. Okay, so point two. So with the U.S. economy in difficult shape, it's going to be it's going to be more difficult, I think, in the future to grow the U.S. economy. GDP is going to be pressured by the need to reduce government spending since deficits are at unsustainable levels. Real GDP for the last 40 or 50 years has averaged about 3.3% real growth per year. That number is likely to be closer to 1.5% to 2%, even in the best of circumstances over the near to intermediate term. Savings rates, and this is a bad news, good news story. Savings rates have to go back up. They are going back up, not to what they've been historically, but they're going back up. That's good news because it repairs the balance sheet of all the people in this room, but it's bad news in the sense that it's a dollar not spent on consumption, which is part of what creates GDP and job growth. Interest on our national debt is poised to go higher, and that will dampen GDP growth. I've already made that point. And here's a point that's not often looked at, but just is a fact of life, and I don't know that there's anything that any of us do about it, but our population growth is at historically low rates, and we're getting older and we're less fertile than we used to be. And make no mistake about it, part of what creates economic growth and creates returns in things like a stock market is just simple population growth. The more people you put on this earth, the more housing you need, the more, consumer goods you're going to sell, the more you're going to create opportunities for businesses. And whereas our population always used to grow back in the 40s and 50s at 1.5% to 2%, in the 60s, 70s, and 80s, that slowed to about 1 to 1.5%. In the 90s, it slowed to about 70 basis points to 1%. And currently, it's running at only about 0.7% growth per year. And a big piece of that, by the way, is not just us being older and having fewer kids, but immigration policy in this country has been toughened up, and there are fewer immigrants coming into this country than ever before, which some people would argue is a bad thing, is a good thing. I would argue it's potentially a bad thing because immigration is really the lifeblood of our economy in so many ways in terms of bringing in very entrepreneurial people, bringing in new people that work hard. And so immigration is something we should all think about. And then the final point, Europe has got to grow more slowly too. So here are just a couple of examples of that. Here's the savings rate. Savings rate from the 60s to the 90s was about 8.5% of personal disposable income. Back in those days, everybody in this room took 8.5% of their after-tax income and put it in some kind of investment form. That savings rate deteriorated to 5% in the 90s and early aughts. And then we hit a low point in 2005 of 1.6%. That has now rebounded to 3.8%, which is good news, but that's probably got more to go. That will go higher, in my view, over a period of time. And again, that's good news in the sense that people are getting themselves in better economic shape, but that too will create a little bit of a dampener on economic growth. There's just this article I put in here from the Population Reference Bureau, which I'm going to skip, which you can look at your leisure, which talks about some of the population trends that I spoke about. And this is just a quick chart I'm not going to spend a lot of time on that talks about what's going on in terms of a gloomier outlook because of some of the reasons I've already spoken about. U.S. growth, which, as I said, has historically been about 3.3%. Real GDP is now going down more into a category or a range of 1.5% to 2%. And European growth is, virtually stagnant at this point in time, somewhere between 0 and 0.5%, down historically from 1 to 2%. So the investment world, returns, in my view, are likely to remain volatile. Now, investment returns have always been volatile, and it always seems like the recent period has been the most volatile. But there's no question in my mind that the recent period, defined as since 2008, has been extraordinarily volatile, and I think, emotional for everybody in this room because it basically deprived us of the assumptions that we'd all been so comfortable with for the last 20 years, that we'd saved a certain amount, we had X amount in equities. Yeah, it could, suffer through difficult markets, but none of us, I think, expected to have 37% of our equity net worth taken away in 2008. Having said that, 2008 was the worst year in the market since 1931, which is effectively the crash. That said, Markets have now recovered every bit of their 2008 loss. So for anyone in the room that had the courage to stay with their investments, most people have recovered their money at this point in time. And then the other point I want to make here is that on a go-forward basis, markets typically bear a very good long-term relationship to both inflation and interest rates. We can all debate about what we think is going to happen to inflation and interest rates over a longer period of time, but clearly at this point in time, we're seeing extraordinarily low inflation and more particularly extraordinarily low interest rates, and there's no question that those things will have a major impact on what equity market returns have. So I simply quote here, inflation over the last 50 years has averaged 4%. 10-year government bonds, which I mentioned earlier, have averaged 6.5%, so they've yielded a 2.5% real rate of return. As I said earlier, that rate of return at the current time is 0 if you own 10-year government bonds. Stock market returns have averaged 11.5% in a 4% in inflation environment, so they've effectively returned 7.5% real rate of return per year if you've been long-term oriented and stuck with them. But with inflation and interest rates where they are, under any circumstances, you've got to have, reduced and more conservative expectations about what returns are likely to be in equity markets, and my suspicion is most of you do. That doesn't mean that stocks won't continue to be the relative asset of choice if you have a long-term perspective, but I think it does mean that return expectations have to be set accordingly, and hopefully you're doing that. Couple final points is that, although economies are subdued, and I think will stay subdued, in the final analysis, equity returns will ultimately be dependent on corporate profits. We'll get to a slide on that in a minute, but corporate profits have actually been pretty good in this difficult environment, and the question is, can they actually go a lot higher than they are because they've been so good, and that's in part why the stock market has rebounded the way it has. And final point, and we'll get to more detail on this, is equity markets, in my view, are at worst fairly valued, and I would say even somewhat undervalued at this point, notwithstanding all the concern that I've just injected into everybody's view about what the world looks like. So this is just a chart to show you the kind of volatility we've all had to suffer through over the last few years. I mean, these are extraordinary drops as you look at it, a 50% drop from peak to trough from 2000 to 2003, a 57% drop from the peak in 07 to the trough in March of 2009. And then you can see to where we've rebounded to currently. This is just a neat little chart which I like to reference. This again is just another reflection of volatility, but also the fact that you should stick with your long-term asset allocation, whatever it is, because 1987 is probably my favorite year to look at here. So, I'm sitting at Goldman Sachs. It's October of 1987. The market drops 34%. And what do you think the market did in 1987? It was actually up 2% in terms of total return. So you had this enormous downswing. It immediately got recovered by year end, and the market wound up 2%. In any event, there are just some fun numbers in here. You can look at that at your leisure. The next chart is I don't know how well you can see it here. You clearly can see it better in your package. This to me is just kind of a neat reference thing to keep around the house if you happen to be a stock junkie. This is basically the trailing, well, it's the 1 year, then it's the 5-year trailing returns, then it's the 10-year trailing returns, 15, 20, and 25-year trailing returns for the stock market. So if you look at this in the 1990 number, that will tell you in the 10-year category what the trailing 10-year return was the stock market from 1980 to 1990. And what I did was I just, basically plotted in here, okay, what's been the average trailing 5-year return in each one of the last 20 years, and that number has been 9.45%. If you've had the 10-year trailing average over that same 20-year period has been 10.95%. The 20-year average trailing return has been 12.98%. So just a little bit of, again, kind of stay the course, and the longer you're committed to this, the more likely your returns are to improve. Let me just say, too, if you look all the way up at 2011, we have had one of the most miserable 5- and 10-year periods for stocks that you can imagine. So I just got done telling you the 5-year average return over the last 20 years trailing has been 9.45%. The 5-year trailing return for the last 5 years has been 2.6%. It's been awful. The 10-year trailing 10-year return has been 1.58% versus the 20-year average for 10-year returns of 10.95%. So you can just see we've been in a really, really difficult period, certainly over at least the last 10 years, and that's reflected in these numbers, and I think is somewhat nothing more than a response to what we've gone through economically. But in any event, there's some fun numbers in there. I'm going to skip some of these. These are effectively just a little bit of what's going on in the bond market. So T-bills and T-bonds as opposed to stocks, so you can look at that at your leisure. Here's the point I wanted to make about corporate profits. So, you know, we're in a tough economy. Things aren't great at the moment, but if you look at earnings per share are about at record levels for the S&P, and maybe more importantly, corporate profits as a percentage of GDP are basically at, you know, I don't know if they're all-time highs, but they're certainly, you know, highs for the last, 45, 50 years. So corporate America has done a really good job of responding to what has been a difficult environment for them. There's some bad news in this, obviously, in that, you know, part of that has been cost cutting through firing employees. Part of it has been being careful about not hiring new employees. Part of it may be due to the fact that some of the companies may not be making the investments they should be making in their future, you know, to keep their current margins strong. But corporate profits have been the one, you know, kind of attractive picture through all this. Certainly at the current time relative to, you know, how you think about the macro world. This is just a quick reflection of what's happened to trailing PE. For those of you that have some familiarity, I assume most of you do, with what a price-earnings ratio is. This is just a quick reflection of how expensive or cheap stocks are relative to their earnings. But, you know, at 12.1 times, at June 30th of 2012 on trailing 12-month earnings, that would, you know, represent a reasonably inexpensive PE ratio relative to a number that would more typically average 14 to 16 times. Let me add too, and most of you know this, the current dividend yield of the S&P at 1.97%. It was as high as about, I think, 3 or 3.1%, but now it's 1.97%, is still in excess of what you can earn on 10-year treasuries. That's never happened in the history of observation points that I've been familiar with. And so, you know, think about that for a minute. You're earning more just on the dividend yield in the S&P than you are on 10-year treasury bonds. And part of that goes back to that comment I made earlier. The Fed is, whether you like it or not, the Fed is forcing you into risky assets. That's where they want your money to go at this point in time. I mean, effectively what they're saying is, we're going to take conservative savers. We're going to basically put those rates near zero, not because we want to punish savers, but because we effectively want to help overwrought borrowers. So you can debate whether or not you have agreement with that point or not. But the side effect of all that is it's also pushed more and more money into the stock market because, you know, some people say, well, you know, gee, what choice do I have? Now, as I said, the good news on that is even though it's pushed money in the stock market currently, at least relative to its earnings, is not what I would call overly expensive. So it's not like they're forcing you into an asset class that on a lot of other traditional valuation metrics looks terribly expensive. But nonetheless, that's part of the net result and the impact of what the Fed's doing at this point in time. So, therefore, investment strategies to me today need to incorporate a very realistic risk tolerance, time horizon, and return expectation. You know, we talked a little bit about this. You've got to assume that your risk assets, whatever they are, could go down by, you know, I say 20 or 25% tomorrow, you know, up that number. Assume 25 to 30%, which doesn't mean that you're going to suffer some permanent loss. And as I said, I don't personally think equity markets are overvalued at this point in time. I think you can argue they're a little bit undervalued, but nonetheless, I think you've got to be prepared for that kind of downside, because if you're not, you're simply going to panic out of your assets at the worst possible time, and that's the way you will truly lose money, is to you know, leave the stock market at exactly the wrong time. So point 2, therefore, be committed to your asset allocation. Biggest mistakes occur by panicking out at the bottom, at which point it's impossible to earn your capital back. Third point, low risk assets, as I said, are just going to earn zero. Now, that doesn't mean people in this room shouldn't have low risk assets. If you can't afford to take risk, to me, you're better off swallowing the fact that you can't earn a return on your assets at this point in time than you are taking risks that are inappropriate for what you should be doing. But nonetheless, your low-risk assets are currently earning about zero, and I'm not sure I see that changing anytime, certainly in the next year or two. Beyond the next couple of years, I don't know, we'll see, but I think the next couple of years, they're likely to stay about where they are. I then put in here just the impact of that on what you would call kind of a classic 60-40 stock bond asset allocation. I just refer to this because a lot of endowments compare themselves to what you'd call kind of a classic 60-40 mix of 60% S&P or stocks, 40% bonds. But you can see, just based on my math, which I've talked about earlier in terms of return characteristics of what bonds tend to yield over inflation, what stocks tend to yield over inflation, you know, your return expectations should probably be a minimum of 200 to 300 basis points lower than they've been, you know, over, you know, the historical investment period that we're all familiar with. The cash yield on your assets becomes important in a low interest rate environment, i.e., you know, things like dividends probably mean a lot more today than they did, you know, 2 or 3 years ago. And we'll get to a slide in a second that talks to that. But, you know, the more that you can generate some amount of current income in asset classes that you think have some amount of security to them relative to their risk, you know, that's a good thing. The other point I want to make is fees become incredibly important to all of us in this kind of environment. And I just make a couple, you know, very simple mathematical calculations here. But, you know, 1% fees, 1.5% fees in an environment of you making 11.5% may or may not be acceptable to you. 1% fees, 1.5% fees in an environment where you're making 6%, 7%, you know, somebody's taking 15 or 16% of your income. And so you just need to be aware of that. We'll talk about that in a second too. This I just threw in because of the chart on the upper right, you know, where it talks about capital appreciation and dividends on the S&P 500. So that little bar on the far right is basically history for the S&P 500 in terms of where its return has come from over the last, 90 years? Yeah, about 90 years. And what it says is that 42% of the entire return of the S&P over that period of time has basically come from its dividend. Ergo, why you're seeing a lot of people today focus on, you know, dividend returning stocks, high quality stocks. You know, there's a big focus now on, you know, some of, I won't call them the nifty 50, but there are a lot of people, a lot of asset managers today focused on, you know, the Coca-Colas, the Procter & Gamble's, the Anheuser-Busch's, or AB InBev's as it's now called, because, you know, some of those stocks are yielding not just that 1.97% average return for the S&P, but are yielding 2.5%, 3%, and are perceived to be, you know, secure global entities, and will, you know, likely do well in the environment that we're talking about today. I guess, kind of in semi-conclusion, individual asset allocation today requires a long-term perspective and the ability to withstand volatility. I've made that point, but a bunch of follow-up points. So biggest decision is always how much of your capital you're willing to take equity risk with. That's the first decision that all of us have to make, that I have to make, that you have to make, because I think virtually anything other than cash or very short-term bonds, you should consider to be some kind of a risky asset. I don't care if it's gold, I don't care if it's real estate, I don't care if it's commodities defined as timber or infrastructure assets, I don't care if it's stocks, I don't care if it's high yield. They're all, in some sense, risky assets, and we can grade them in terms of, okay, stocks are a little bit riskier than high yield or whatever, and you can do that math in your own minds, but be really, really careful, in my view, about making sure that whatever you're taking equity risk with, and that's a lot of things, that it's a risk you can accept based on some of the parameters I just mentioned. Don't market time your equity exposure with dramatic moves in and out of stocks. This is a number we used to quote all the time at Goldman Sachs, but there was one study done in the 20 years from 1987 to 2007. If you missed just 40 days during those 20 years, just 40 days, and they were the wrong 40 days, you put your return from 11.8% down to 3.9%. So, markets, although they compound at 9 or 10% a year, tend to have really dramatic moves that create a big chunk of that 9 or 10% long-term return. And if any of you can figure out which days are going to be represented by that, you're smarter than I am, and go for it. But that's not what any of us can typically do, and so you need to have a long-term commitment. Don't overcomplicate your life with asset classes you have no knowledge of or conviction in. This goes to the notion of, if you decide you're going to be in some technology fund because, somebody tells you technology is the future, and then, markets go down 30%, your technology goes down 40%, and you regurgitate the thing out, you haven't done yourself any favors. And at least my personal experience has been, you'll tend to stay with things and have conviction in things that you know as opposed to things that you don't. Employ index funds and exchange traded funds for asset classes where you doubt the skill set of a manager to outperform. This to me is a fairly easy one, and frankly a luxury we all have today that we didn't have 10 or 20 years ago. If you all have the insight and the conviction and the knowledge to be able to find managers that can do a good job of outperforming benchmarks, then that's what you should do. But for those of you that don't have that expertise or insight, there's nothing wrong with index funds, and there's nothing wrong with exchange traded funds, which in many ways are, the mirror equivalent of index funds. Although, as I say here, I would avoid ETFs that employ leverage, but they are very efficient ways to invest your money if you don't feel you have an edge in a particular asset class. The typical expense ratio for an ETF is going to be well below what you're paying an active manager, and as I said, when you're only earning 6 or 7% on your money, that can make a difference. I'm not here to give a lot of specific investment advice, but as I said, one thing I would avoid is avoid long-term bonds at this point in time. I just don't see how anybody can be investing in 10-year government bonds at 1.7% and expecting that they're going to make a reasonable return after inflation on that money. You're better off staying in cash, earning 0 in my view, as opposed to taking that kind of risk. I will say too that a good way to think about bonds, I'll look at Rick Gessoff, who's here with me and taught me much of this business 30 years ago, is to do something that's called a break-even analysis, which once we get back into a more normal rate environment, if 5-year bonds are paying you 5% and 10-year bonds are paying you 10%, you shouldn't necessarily always just buy 5-year bonds at 5% because you'll get your money back sooner and you're afraid of inflation. What you can do, and anybody can do this, is just say to yourself, okay, anywhere on the yield curve, if I think I can earn an extra 500 basis points and I look out 3 years, I can lose that extra 500 basis points on that 10-year bond to a depreciation in the asset and still be no worse off than I was buying the 5-year bond, right? Because the 5-year bond paid you 5%, the 10-year bond paid you 10%. So even if it goes to 95 at the end of the first year, you have the same amount of money that if you bought the 5-year bond. Well, if you run that math out 3 or 4 years, 4 years out, that 10-year bond can be trading at 80 cents on the dollar, and you're still no worse off than if you bought the 5-year bond. Well, but if the 10-year bond is paying 10% and it's trading at 80 cents on the dollar, the effective yield on that, or the implied yield on that, could be 12 or 13 or 14%. And you say to yourself, well, what's the likelihood that 5-year rates are going to be at 13 or 14%? And it's just an easy way to kind of think in very simple terms about whether or not you're being paid for the risk you're taking by going out on the duration curve or the yield curve. And to me, the answer on that today is idiot simple. You're just not being paid for holding long-term bonds, so don't do it. Notwithstanding the macro environment, I've said this, stocks, to me anyway, look fairly valued or slightly undervalued. European markets, notwithstanding all their problems, actually look pretty cheap. We'll talk about this in a second. Worthwhile having some exposure to emerging markets if you're willing to have some assets in a risk asset class. We'll get to that in a second. And then I just throw in a cheap shot at gold. I mean, I have nothing against gold, but to me, gold may work as an investment, but none of us will own enough of it to make a difference if it does. My view there is simply that if you have this Armageddon scenario where you really think inflation is going to come back and eat us alive, well, then we should all have 50% of our assets in gold. But to me, that's the only way it's really going to be an effective hedge versus that Armageddon scenario. Because if we all have 4 or 5% of our assets in gold, it's not going to be enough to make a difference. Meanwhile, it's an asset that pays virtually nothing to you, and I think, at least in my view, is largely at the forces of emotions of the public. And it's hard for me to give you a valuation reference for gold, because so much of the world's gold isn't consumed. Gold is simply collected, and it's collected by people for all kinds of reasons, and it's been a good investment. I don't want to say it hasn't been, but I just have a particular view that it's not where I'd have my money. This is just more of a little bit what I already showed you. If you have a long-term time horizon, you tend to narrow the bands of what your returns are over a period of time, and you clearly take away the opportunity for long-term loss. This next chart really just shows you what have been the assets of choice on a 1-year basis over various points of time, and then there's a 12-year chart or an 11.5-year chart on the far right-hand side that happens to show you that at least in the last 11.5 years, MLPs happen to be the best performing assets. Real estate was second, emerging markets were third. I mean, I think all this argues for is you should have some amount of diversification in your investment portfolio. I wouldn't go too crazy with that, but you can see by virtue of the fact that you don't that often get the same color across the top of the chart, that there are different asset classes that do better over a period of time. So, use your own judgment. This next one I like for a reason that's probably not the reason that JP Morgan has it in their chart, but this shows, according to a recent JP Morgan presentation, kind of what I would call a more sophisticated investor would have their assets invested in on the right-hand side. And then on the left-hand side, they show what a simple allocation would have been that's effectively 70% equities and 30% bonds. What I like about it, though, is they're trying to make the point that, okay, diversification, it really pays you to do a lot of fancy things, in terms of including hedge funds and so on and so forth. I almost look at it and make the opposite point. The return on this portfolio over a period of 17 years is 7.09% for their very diversified portfolio, and it's 6.75% for just the simple idiotic, 70% stocks, 30% in bonds. So to me, there's just not that big a difference in there. I would say too that that at least in my own mind, and we'll get to this in this chart. This is another chart that Goldman Sachs puts out, which talks about, okay, here's how you should think about what they call a low volatility portfolio, then a conservative portfolio, a moderate portfolio, and a fully aggressive portfolio. And you can see in here what the return characteristics are of those various portfolios over both a 20-year period and a 40-year period. So I'll let you just noodle that at your leisure. The one thing I would say about this, though, is to me, their notion of a conservative portfolio is really conservative. I mean, you know, the notion that somebody's going to have 75% of their money in fixed income, I think that's, frankly, an appropriate asset allocation for somebody that has very little chance of having, you know, any real income options at this point, or any real opportunity to take risk and to earn an outsized return, or earn a better return than what 0% fixed income is paying you at this point in time. I just make the editorial that I think that's a very, very conservative asset allocation. The other thing I'd say is, to me, for your risk assets, however you dial in fixed income versus equities, I would start with kind of a default portfolio within your risk assets that would include some amount of U.S. equities, international equities, and emerging markets. Those three asset classes, to me, should be a building block for your risk assets, and then add on to that as you choose whatever it is. You want real estate, you want, you know, infrastructure funds, you want MLPs. I think those are all things that if you feel you have the sophistication and the comfort with them, you can probably use to enhance the diversification of the portfolio. But to me, three core pieces of your risk portfolio, whatever it is, should be U.S. stocks, developed international stocks, and then emerging markets. This is a really neat chart. This basically shows you a little bit about what we talked about earlier, but what it says is if you look at the return of markets over a really long period of time, you get big periods of really crummy returns. And then in a lot of cases, they're followed by, you know, extraordinary returns for a period of time. And over a period of time, it all averages out to the kind of numbers that we've spoken about. Now, you know, obviously, we've now been in a 13-year period that's really crummy. I can't tell you it's not going to go another 5 or 6 years. I mean, the longest period we've ever had like this was back 1906 to 1924, where you had 19 years where the markets basically did nothing. I mean, if you took advantage of the volatility, obviously you made returns, but for the average index investor, you had, you know, a long period of time where you made no money. But then most of those periods have been followed by, you know, some very significant up periods. And I don't want to overemphasize the doom and gloom of what the world looks like today. I mean, I do think it's a reasonably gloomy place looking out over the next 2 to 3 to 4 years. I think it's going to take a long while to fix our problems. But I don't think that should deter any of us from the notion that you've got to have some normalized sense as to what your asset allocation should be, and maybe you go a little bit to the more conservative end of that over the near term. But to do something really dramatic in terms of being incredibly conservative with your assets at this point in time is not what I would do, because I don't think that will serve you very well over the next 10 years. These are just some statistics I'll let you look at on your own that, you know, kind of, to me, quote where the U.S. equity market is today. I'm not actually a big believer in the bottom chart, which is what they call normalized earnings. But you can see that the chart up above shows that stocks relative to their earnings, relative to their book value, relative to their cash flow, look reasonably cheap at this point in time. This is just a chart that says the same thing about not just the U.S. but Europe, and shows in the far left-hand corner, these are kind of standard deviations. So negative numbers are good because they mean cheap on a standard deviation basis to where These various markets have been relative to, again, PE, book value, price to cash flow, and dividend yield. And Europe looks cheaper than the US at this point in time. It may stay cheap for a period of time, but probably a reasonable reason to at least think about it. By the way, this chart says that the US is slightly overvalued with a plus number. I don't know how they get to that because every one of their components shows it cheaper than what the 10-year average is. But nonetheless, fair value to slight undervaluation. Here are emerging markets, and we'll talk just for a second about them further too, but they basically look cheap relative to where they've been. Not all, but many of them, and particularly the bigger ones. This is just a chart of what the spread on various fixed income instruments has been in the 7 to 10 year category relative to history. So peaks are good, meaning that's where you would want to invest because the spreads over treasuries are high. Valleys are not good because that means you're basically back to normalized. But if you look at the averages here over a long period of time relative to the norms, I wouldn't say that any of the fixed income markets are particularly cheap at this point in time. This is municipal bonds. For those of you that have owned municipal bonds for a long period of time, good for you because they're all trading at premiums. I'm not sure I'd put a lot of new money in municipals today. The good news is that munis are paying 142 basis or 142% of what 10-year treasuries are because this is basically a 10-year ratio. But the problem with that is 140% of 1.7% is not a great number, even though, municipals have historically averaged only, 92% of what other fixed income is paid. So again, I just don't think the bet there is a terrific one. And then final couple of charts. This is why emerging markets are an interesting place to think about. So by the year 2050, virtually everyone believes that China will have a bigger economy than the United States. The Chinese economy today is $8 trillion. The U.S. economy is $16 trillion. The expectation over the next 10 years is that the U.S. economy will grow by about $4 trillion. So it will basically grow to about, let's call it $20 trillion. The growth in the Chinese economy will be twice that, will be about another $8 trillion. So just by the year 2022, the Chinese economy will be about $16 trillion versus the U.S. at that point, which is $20 trillion. And you can see that by 2050, China is expected to easily surpass the U.S. economy in terms of its size. It's tricky in that, it doesn't necessarily mean that their stock markets will go up in step function with what their GDP rises by, but there certainly has been a reasonable historical correlation over a period of time. As I said, profits, are important to stock prices, but it's fair to say the expectation would be that there are going to be lots of stocks in places like China and India that do very well over a period of time. India is another example. India's current economy is a $1.8 trillion economy. Their economy is expected to grow by $2 trillion over the next 10 years, so generate half the growth that the U.S. is generating from a base that's, effectively one-tenth the size. So my view is, notwithstanding the fact that there's lots of volatility there, that's probably a place that people should make a long-term bet at a point in time. And as I said, you can do it through ETFs, index funds, just to take a simple approach if you want. This is the last reason to own emerging markets. Virtually all of the world's population growth in the next 40 years is going to come from emerging markets. And by the way, they're not growing that dramatically. If you did the math on this, what you'd see is that growth in emerging markets will be about 1.5% per year. I was actually surprised by that. I thought that number would be more like 3% plus. But emerging markets like the US and developed markets are actually seeing their birth rates come down as their standard of living increases. That's probably due to a lot of reasons, and in China it's obviously because in part it's being controlled, but this will be a big wind at your back in terms of why those emerging markets will grow more quickly than other markets. So with that, I'm done, and I appreciate your time, and if there's a question or two, I'm happy to take it, and yeah.
How would you modify your presentation after November 7th, depending upon the outcome?
I think that's a hard one. I mean, I don't want to get into politics at this point in time. As I said, I think my expectation would be that markets over the very near term would probably be lifted by a Republican administration as opposed to a Democratic administration. But I don't know that that makes a difference for the next 2 to 3 years. Here's the real key, and make your own decision. Whoever it is, whether it's Barack Obama or Mitt Romney, somebody has to do one of two things. They have to get the federal debt under control. They've got to find a way to cut spending, and that's going to take money out of consumption. It's going to take money out of GDP. So query, how can you do that at the same time that at some point you've got to wean us all off the Fed? The Fed's got to stop buying 90% of the mortgages in America the way it is today. The Fed has got to get out of what has traditionally been a private capital market, and at some point it's got to allow rates to reflect what normal economic activity is. And I think that's going to be really, really hard to do in a political context for either one of those people. And so it really depends. To me, the long-term answer, and I don't know who will do it better, Romney or Barack Obama, is they've got to find a way to create economic policies that create enough growth to allow us to suffer the drag of weaning ourselves off of all this debt without, seeing employment rates go lower or unemployment go higher and seeing interest rates soar. And I think, it's a really, really tricky equation. I don't know who will ultimately answer it better. Yeah, Stuart.
Yeah, alternative investments returns have been mediocre now for a few years, but they are less risky and they add diversification. What do you think? What role should they play going forward? Hedge funds, private equity, managed futures, and so forth.
Yeah. I think it's. I think alternative assets, embodies a huge umbrella of things. And, to me, at the end of the day, the things that create return in alternative asset classes aren't any different than what create return in a lot of cases for the S&P 500. Now, that's not true for things like timber. So if you're talking specifically about things like a timber fund or an infrastructure fund, we could debate some of those things. But private equity, if you will, to me is a lot of very smart people who have levered up their equity bets and have produced good returns over a period of time. I think what's made alternative asset classes so attractive is some of the best and brightest people in the investment world, in my view, have wound up investing in a bucket called alternative assets. And there's no question that there was a long run of time from mid-'80s, early '90s, right up through, mid-2000, 2005, when the returns that those managers made were exceptional. They were far better than what the market generally had been, primarily in private equity, but also in hedge funds. And I think, the question going forward, Stuart, is there still the same caliber of talent in those asset pools? And my answer to that, by the way, is yes, but in a smaller subset of them. So you better be good at picking who they are, because relative to the comment I made about fees in the alternative asset class are much higher. And so you've got to own those top 15 or 20% of the managers within that asset class, because they're the only ones that ultimately are going to outperform over a period of time. If you can find them, if you can access them, I would clearly take advantage of them. If you can't access them, you can't find them, then to me, you're not going to do that much worse by simply, employing a more simple, more direct equity strategy like what I mentioned. I mean, every 100 basis points is obviously important, but to me, you've got to have, and someone like you probably does have, the expertise to be able to find that subset of managers that can truly outperform. Because I think it's going to be a lot tougher in the next 10 years than it was the last 10. Yeah.
On the chart in the national debt on page 5,
Yeah.
if you look at it, the past 12 years, the national debt has been going up, but there's no tremendous jump from the past 4 years. And since the year 2000 on this chart, how come all of a sudden this has become a problem? The last 12 years in politics, nobody was talking about the national debt. Nobody was doing anything about it. We cut taxes, we weren't paying for 2 wars, and the national debt was going up, and so what? Why is it all of a sudden so important?
Well, let me say this. I don't think it was unimportant to some number of people over a period of time. I take your point that there have been deficits in every year of this country's history, but I don't know what it is, 8 or 9 or 10. Okay, so deficits are, something that we've lived with, frankly, since we became an independent nation. The issue becomes we've always been able to grow at a rate where the economic growth of this country has allowed us to leverage it, if you will, through some amount of debt and be able to repay that debt in a way that's sustainable to both grow the economy and basically keep those debts in check. You can agree or disagree. I mean, it's a personal matter, but when debts get to, or deficits get to $1.1 trillion a year on a $16 trillion economy, you're basically saying that, that 8% of the entire economy is basically being hawked every single year. And I will just tell you as a simple matter of math, you can't do that forever. You can't, we will get to a point where this number will be 120 or 130% of our GDP. And, even there, we may be able to sustain that burden of debt longer than other people have, but at some point it comes home to roost, and make your own decisions when you think that is. But I do think, my point is, whether you think it's critical to you or not, I do think it will have an impact on the investment world over the next 5 years. I do think it will create some amount of drag on returns, which is really more my concern, is to just talk about what we all think we can earn on our investment returns over the next 5 years. Yeah, in the back.
You talk about international and emerging markets as being good for diversification, and I know many investment advisors do that as well. But since we have become such a global economy, I believe that many of those markets have moved in tandem with even domestic equities, and they always scare me because they seem to be a little more volatile. And wouldn't it be okay to invest in domestic equities that have good international exposure? I know there's, the currency risk, but I still don't feel comfortable with emerging markets.
Then you shouldn't do it, and the answer to your question is yes. I mean, I think you'll find plenty of U.S. companies. I don't know what percentage of corporate profits today are coming from international activities, but it's a fair number and it's growing. And it's fair to say, if you can find a manager that can invest in some of these high quality international franchises I've talked about, I wouldn't, given what you just said, I wouldn't invest in emerging markets. Having said that, let me say this. Emerging markets in the last 3 years have done nothing close to what the U.S. market has been. Since the crash in 2008, the U.S. market has been the superstar. China, India, Brazil, Russia, those markets have been terrible. And so, there's a sense that, those markets on a relative basis are pretty cheap right now to what their history has been. But there's no question, you're right. I mean, if the U.S. market goes down 20% tomorrow, I promise you emerging markets are going to go down 30 or 35. Money is going to run out of them. But that's not to say they won't represent a good longer term investment if you've got a long time horizon. But given what you said, I wouldn't invest in emerging markets for you. I'd stick to what you're comfortable with, and I don't think you'll do that much worse. So do that.
Yes, what role do you think the repeal of Glass-Steagall had in where we are now? And do you think the Frank, or the Dodd-Frank bill is going to be helpful? And is there other legislation that we should be having to try to get us in a better, to help the economy?
Yeah, I don't know. I hesitate to try and answer that. I think there's a political question wrapped up in that. I will say this, that you know, the banking business as a business, well done, is a 12% ROE business that probably grows at 4 or 5% a year. Our financial institutions, by and large, with the exception of '08, have done a lot better than that. JP Morgan employs 250,000 people worldwide. Those are good paying jobs that have over a period of time benefited this economy. If it were a simple mortgage lender taking deposits and making consumer loans, my suspicion is JP Morgan would be less than half the size that it is today. You can argue that's a good thing because, you know, perhaps there wouldn't have been the bailout as it's described. You could argue it's not a good thing because, you know, as Jamie Dimon would say to you, all the activities therein, you know, are ultimately, he thinks, productive for the U.S. economy long term, and I agree with him on that. And if J.P. Morgan doesn't do them, somebody else will. It'll be Credit Suisse, it'll be SocGen, it'll be HSBC. So I think there clearly is a place for regulation. I don't know how far Dodd-Frank will go. I don't know how far the Volcker rule will go. It's a big political football at this point in time. My personal view is I think the bank should have the ability to do more than just traditional simple lending, but that's one man's view, and I can understand why somebody would take the opposite view.
What part do you think a person's age should play in his asset allocation?
Big. I mean, you know, listen, I hope we all live to be 95 or 100, but I think, you know, if you know, I mean, I'm 60 years old, or actually I'm not, I'm 59, I want you to know that. I'm soon to be 60. But I have a different view of the world than I did 20 years ago, and I don't think you can ignore age, because God forbid, you know, when one of us passes, you're going to leave, you know, your estate to somebody, and God forbid it's at exactly the wrong time to liquidate assets, and assets have to be liquidated to pay taxes. I mean, I think age has to play a part for sure, and you gotta be careful about balancing that risk return characteristic when, you know, and age has to be part of that.
Even other of us in this room have late 20-year-olds who are about to embark on their careers and their lives. What would you recommend that they start doing at this early age? I mean, a lot of them obviously don't have enough to establish portfolios. What advice can you give them to launch their lives in this sort of very shaky economy?
Well, I don't know that you do a lot different than I did when I was first starting out. I mean, I think most employers today have 401k programs. You know, I think the days of defined benefit programs are gone. They're all defined contribution programs. But, you know, to me, the vast majority of employers today provide 401k programs. A lot of them have matching contributions, and, you know, I think you start small and simply and work up. So, you know, from a very young age, I was taking, I don't know what it was, you know, $200 a month or $500 a month and trying to put it in a 401k. I think that's, I don't know that you start any differently today, Judy, than you started a long time ago. I think the bigger question in my mind is, you know, are our young children, are your children and my children going to have the same opportunities that we had on a go-forward basis in terms of professional careers and in terms of advancement? And I don't know the answer to that one. I mean, I think I will say, you know, I'm part of the, you know, that lucky group of people that spent most of their productive years from 1980 to 2005, and that was a really good period of time. And I think it's fair to say, you know, the next 25 years aren't going to be as good as those 25 years. So I worry about it in that regard. But I think that, you know, I remember in the investment world starting out, very small, and I think you got to start somewhere, and that's as good an answer as I can give you.
Maybe even one more.
Yeah, okay.
As a student, what are the skills we need to have to be a finance person? Like, which skill we need to look for?
Well, I'm not sure I know how to answer that question. I mean, there are many people in this room that I don't think are skilled financially, and I think a lot of it just depends on your own, desire to educate yourself to what goes on in the investment world. I think there's lots out there that one can read, but I think you basically dial your investment strategy to a sophistication level that's appropriate for you. So if you tend to be very sophisticated and you tend to want to spend a lot of time at it and you're good at it, then, to me, you can do some reasonably complicated, sophisticated things with your investment life. If you're far from sophisticated, I would do what I suggested and start with the notion of, okay, how much risk do I want to take? For my risk assets, I'm going to have some representation in U.S. stocks, international stocks, and emerging markets, and then expand from there if you're comfortable with it. I don't have a better answer for you. Okay, great. Thanks, everybody.